The fair value gap you are drawing is respected 57% of the time, a coin flip. But a real fair value gap, the one ICT actually described, is respected 77% of the time. We tested over 500,000 of them across 5 years of the Nasdaq and the S&P to find the 20-point edge the gurus leave out. Because every channel teaches this pattern the same way. Find the gap, mark the zone, wait for price to come back. And most of the gaps they tell you to mark are not fair value gaps at all. By the end of this, you will know exactly which gap pulls price back and which one is fooling you.
Okay, what is a fair value gap? It is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower.
Listen to what he actually said. Displacement, energy, a gap torn open by a violent move. He never said, draw every 3-candle gap on the chart. He described a specific event, and then the internet flattened it into one rule. Gap equals buy zone. So we coded his real definition and tested it, his way, against the way it gets taught.
Is the volume imbalance, okay? Look at the bodies respecting it in here, and then we get one little spike that takes out these relative equal highs, and then it goes low.
3 different things. ICT taught them as 3 different things, and the internet calls all of them fair value gaps. Here's the difference, and it is the whole video. A real fair value gap is a true price gap. The wick of candle 1 and the wick of candle 3 do not overlap. There is empty space. A volume imbalance is different. The bodies gap, but the wicks still touch. There is no real hole in price, just a fast handoff between one candle and the next. And a liquidity void is the big one-sided run with almost no trading inside it. The problem is the volume imbalance and the real gap look almost identical at a glance. So which one are you actually drawing? We counted every single one. 5 years. The Nasdaq and the S&P. 2.5 million candles. The machine found 557,000 fair value gaps. Real ones, wick to wick. Then it counted the volume imbalances, the body gaps that get mistaken for them. 1,921,000. For every genuine fair value gap on your chart, there are between 3 and 4 imposters that look exactly like it. 3.5 to 1. The odds you are looking at a real gap right now are not good. Now the question that settles it. When price comes back, does the gap type even matter? First, how we measured it. Because without a definition, this is just another guru saying, trust me. We are not scoring wins and losses here. We did that last time, link above. This time we asked one cleaner question. When price returns to the zone, does it actually react off it, or does it slice straight through? React means price pushes a full gap height back in your favor before any candle closes through the far side. That is a respected zone. Closing through is a violation. Same rule for every gap. Here is the answer. Real fair value gaps were respected 77% of the time, 3 out of 4. The volume imbalance, the imposter you are probably drawing, 57%. A coin flip with a little lean. That is the gap. 20 points of edge, gone, because you drew the body gap instead of the price gap and called it the same thing. One thing we checked surprised us. A real gap that also contains a volume imbalance was no better than a clean one, 77 versus 76. So it is not about stacking the volume imbalance on top. It is about whether it is a real gap at all. So why do real gaps work better? The same reason ICT gave you on day 1, displacement. Of all 557,000 gaps, only about 1 in 4 were actually born from real displacement. A middle candle big enough and one-sided enough to count. Those gaps were respected 82% of the time. The other 3/4, the lazy gaps from quiet candles, dropped to 75. And this is not the first time the data said this. Last video, we coded the famous 6-step FVG checklist and tested all 6 rules. 5 of them were noise. The one rule that survived, the only one that moved the needle, was this. The gap had to come from a move that broke structure, displacement. Two completely different tests, the same answer. The gap is not the signal. The move that made it is.
There is one more thing the gap type does not tell you. Size.
We graded every gap from smallest to largest and lined them up. Watch what happens. The smallest gaps, the ones you squint to draw, the little nicks you mark 10 times a day, were respected 58% of the time. Basically a coin flip again. Climb the size ladder and respect climbs with it, every single step, all the way to 85% for the biggest gaps. There is no magic threshold. It is a straight line. Bigger gap, more respect. So when you mark a tiny gap because the rule says mark every gap, the data is telling you that you just drew noise.
So why does everyone teach it the wrong way?
They are not lying. They are simplifying. ICT described a specific, violent, structural event, and 1,000 videos sanded it down into draw every gap and buy. And draw every gap tests like a coin flip because most gaps are the wrong type from the wrong move at the wrong size. The edge was never the gap. It was the 3 filters they left out.
Now the honesty part. The part the other channels cut.
Respect is not profit. A zone reacting is not the same as a trade you could enter, stop, and bank. That depends on your entry and your stop, and we tested that separately last time. This is the Nasdaq and the S&P, 1 minute and 5 minute from 2021 to 2026. Not gold, not crude, not your favorite coin. And respect is our definition. 1 gap height, 60 bars. Move those numbers and the levels shift. The script is public. Rerun it and disagree. What does not move is the shape of it. The real gap beats the imposter on both markets, on both time frames, at every size. We are not telling you fair value gaps are magic. We are telling you the one you are drawing is probably the wrong one, and now you know which. So here is the whole video in 3 lines. 1. Is it a real gap, wick to wick? Not a body gap. If the wicks overlap, it is a volume imbalance, and that is the coin flip. 2. Did it come from displacement, a violent move that broke structure, or a sleepy drift? 3. Is it actually a size worth drawing, or a nick you should ignore? 3 filters. That is the difference between 77% and a coin flip. We built the scanner that labels every gap on your chart, fair value gap, volume imbalance, or liquidity void, grades its size, and flags the displacement. Free in the Discord, link below. We test, you decide. And the next time someone draws a gap on every candle, you will know exactly what they are not telling you.